Welcome to the daily update. This is being prepared Tuesday, September 20th, where we'll look at the action in the market today and then see how things look for Wednesday, September 21st. And I don't know if this is going to sound a little different. I'm in a different location from where I usually record. It might be a little more echoey. I've had to shift things around a little bit due to construction that's going on. Anyway, I was also hoping that maybe I wouldn't do a full-blown video after Tuesday's session, but we had enough of a decline and there's been some changes in the charts. So I went ahead and did the full-blown video in addition to the daily brief. And also, I want to say a heartfelt welcome to any new subscribers. I've noticed it's been climbing a little bit, and I'm very grateful for that. I appreciate the folks that want to take the time to watch these videos and subscribe to the channel, and every once in a while even hit the like button. So thank you. I really appreciate that. So let's go back and talk about what happened on Tuesday. Right at the open, we're seeing kind of a pattern. Now, this pattern is still holding up, but it's not making our charts show the improvements that we were seeing after Monday's session. We did gap lower down to S1 at 38.59, and then we fell even below that. Prices almost got back to the daily pivot at 38.80. As the day went on, prices declined, but didn't get down to R2. This is one of those strange days where we stopped either above or below different pivot levels where we usually are right on top of those. But the R2 level was at 38.18. We didn't get down to that point. Going into the close, this is the pattern that we're seeing. Late day buying took prices almost back to S1. Now, we finished down on the day, but what we've seen now over the last 3 days is this pattern of early weakness and then strength coming into the close. That, to me, is signaling that the smart money lets the amateurs do what they want to do for a lot of the day. And then the last 1 to 2 hours that the market is open, then they start going in and doing their buying. Now, we'll have to see. Is that going to continue? Is it going to lead to anything? Is this going to give some support to the market? We just have to see how that plays out. But those are some clues that I'm picking up right now. However, even with the improvement, we still were down 1.13%, and volume is still, it's right about on the moving average. So I'm saying it's still below average. The number's just slightly underneath that. The technicals have pretty much switched back over to negative. Some of the positive things that I pointed out in yesterday's video, they're pretty much gone now. But I'm trying to find some positive things nonetheless, because we are still decidedly negative. Inflation and interest rates and growth concerns, as well as Fed speak. That's what will be the fixation in Wednesday's session. The Fed is meeting. They're going to make their announcement at 2 p.m. The market will gyrate in reaction to that. Then 30 minutes later, Chairperson Powell will start the press conference and the markets will react. Now, one thing that I've noticed over the years is that if we see a counter trend move, we're in a downtrend right now. But if we see a counter trend move, that would mean up from here. The market, for some reason, really likes what they're hearing. The market may do this for a day or two, but then has a tendency to revert back to the previous trend. If we were in an uptrend, COVID was a really good example of that. We were in a solid uptrend. Everything crashed. Everything looked like it was just going to fall apart. Well, then we bounced up out of that and then resumed the uptrend. And then 2021 ended up being very powerful. Other times when the Fed has reacted, the market will react in the opposite way of the trend. It takes a few days to clear out, and then it resumes the trend that it had before. That doesn't necessarily always mean it's going to happen that way. It's just what I've noticed over the years. So we want to keep that in mind. We're in a downtrend before this announcement is going to be made. We might continue to go down, but we're starting to get to an oversold condition right now. So that would actually probably be a little more healthy rather than just some emotional response that lasts a couple of days that works off some of this oversold condition before we get set to go lower. It would actually be a little bit better if we could kind of go sideways to down a little bit get completely oversold, have fear really reach extreme negative, that might produce a stronger bounce in the long run. But that's just speculation on my part, just playing out different scenarios that might happen. All right, so what are some comments that we can make? This is what I've been seeing, and then telling you about. The last 3 sessions have seen early weakness with late day buying. The S&P did end up falling below Friday's level. That was a positive point in Monday's session. That was the low for Monday. Well, we broke through that. But then buyers entered after that and took us back above it. But the fact that we broke through that low is kind of a short-term negative. And then there was some concerning inflation data that's been coming out of Germany and Japan. I guess we're going to kind of have to get used to that. It's concerning when we get US data. It's concerning when we see European data and now Asian data. It's pretty much worldwide what's going on right now with this inflation situation. There's a lot of jitters ahead of the Fed meeting on Wednesday. All of 11 sectors ended up declining in Tuesday's session. The transports hit another 52-week low, and we're starting to see a negative divergence in Dow theory. And I have a chart, I'll show you that, at least in the short term. The select improving technical picture, the positive things that I was trying to pick out, those pretty much are vanishing now, but we'll still try. And we're becoming oversold with these declines. A lot of our indicators are starting to get extreme negative. It doesn't mean that we have to stop right here and turn around and go the other way. We still could have some more declines in store before we become extremely oversold. The 30 to the 5, the 10 to the 2, and the 10 to the 5, those are still inverted. Broken record with that. Sentiment, it pretty much was unchanged according to the index that we use. Even with a greater than 1% decline, it's like, okay, it's like people are expecting this, and maybe they've already set things up, but they're not really freaking out at this point. The economic reports that came out, we had housing starts that came in a little stronger than expected, so that could be seen as positive. But then the building permits came in weaker than expected. And this is also a leading indicator of things, that we might be seeing some slowdown in the housing market into the future. Our trend, we're just barely above 20, and the red line's on top. So now we are in a negative trend. Our bias is negative with the down day, and the last number of days, for the most part, have been negative as well. So our momentum is also negative. So this hasn't changed either. This is, as of Tuesday's close, there's an 82% chance that the Fed is going to raise rates 0.75%. That's the announcement that they're going to make. There's still 18% of market participants that think we could bump it up a full percentage point, but that's pretty low right now. It's looking like the 0.75% raise is what's going to happen. Sentiment, we didn't even budge. We were at 37 yesterday. We're at 37 today. We're in the fear area of things, but not showing an extreme reading. That's usually when we drop down below 25. Here's some Isabel net charts. This is just showing equity positioning. Those people that are in stocks, they're still having a tendency to be underweighted, but they haven't gone extreme. Now, another way to look at this is we did go extreme earlier, and we're bouncing up out of that. But now we're starting to come back down. It just shows that people are pretty jittery about being in stocks right now. Here's the latest reading with the Rydex bear bull ratio. We're starting to spike up a little bit more in the fear side. And if we have any more significant down days, this will probably go up even higher. And then here is yields. We're starting to see interest rates really break out and go to higher levels than where they've been. This is Goldman Sachs. At the time this chart was created, we're at 3.51% with the 10-year yield. The forecast that they have is that we're going to get up to 3.75, eventually 4%, and that we'll top out there in 2024 and then come back down. Now, again, what use are these forecasts? On a personal level, I think they're useless, because every day things change, and what you're forecasting now there's so many variables out there that could change to make this forecast not really worthwhile. However, people look at this and other people make decisions based on these things, and they do different asset allocation plans, and they try to jockey things around because Goldman Sachs is a respected outfit. And so when they come out with information, people like to look at that and maybe readjust things according to that. Personally, I'm just like, okay, this is what a lot of people are thinking, but I don't necessarily see that myself. But then if you look at the futures, they're pretty much going sideways right now. They think that we're kind of topping out at current levels. Well, that can also change pretty quickly as well. Another thing is, if you take out all the big stocks, the mega stocks, this just shows, and now I guess it's FANGMA. They've kind of switched from FANG to they've switched the one of the, I don't know, it's just crazy. It's not even a word anymore. At least you could get FANG out of it earlier. But it's Apple, Amazon, Microsoft, Facebook, Google, Alphabet. All right, good for them. But if you take all those big stocks out, this is how all the other stocks have been performing with their PE ratio, and it's really been dropping. So stripping out mega cap growth stocks, the stock market is trading at recession levels. This is pretty low right now on a PE basis, and the price charts would also stick to this pretty closely as well. Another one is equities tend to suffer approaching the peak in the 2-year yield. That's what we've been watching for, and we're looking at that every day with our 2-year yield spike chart. Well, a lot of times stocks will go down as that spike goes up and then rebound after that. That's what we've been waiting for months now, but it just isn't playing out yet. So you can look at this and see if you get any different information from that, but this is something that we track pretty closely. The euro, again, Goldman Sachs, no matter how much the dollar keeps going up, they still think that the dollar is going to go down and the euro is going to go back up. We're right around the 97 range, which means the dollar is actually a little bit above the par value of the euro. If you can afford it, if you can afford the plane tickets and the fuel prices, this would be a good time to go to Europe. You're getting a pretty healthy exchange rate. The same is true with Britain. The British pound is a lot weaker against the US dollar than it has been in the past. This, and I actually put a little red box down here. This is, according to this chart, our technical score, and we're starting to drop down below 30. So this is getting to an extreme negative reading, but we could still go lower than this. Look, we got down to 7.65 during the COVID plunge, and we could go lower all the way down to 10, but it's starting to look extreme negative, but still has more room to fall. This is the strong dollar and then the downward revisions in the earnings per share. That's what's really hurting some of the companies. They like a weaker dollar. The conversion rates and the import and exports, it makes it look like they have more dollars, and people like more dollars. Well, when you have a strong dollar, that's not as favorable to the earnings per share. And this is an inverse scale. This is the DXY, where I follow the USD dollar index. This is inverted. So that's this gold line going down. It actually is going up, but to match it up, they flipped it upside down. And it just shows how the S&P has been going down as the dollar has been going up. And the earnings per share have been coming down as well. And that's not necessarily surprising. What I've been mentioning in my videos is that if we do see some strength in the S&P, it's probably going to come at the dollar's expense. You might see the dollar declining because they have a pretty strong inverse correlation right now. And that also might give some support to gold, which is not really doing all that well right now. Then the aggregate US equity futures positioning. These are positions, and if you work with options, you're familiar with a thing called open interest. That's just how many contracts are out there. Well, they also have this for futures contracts as well. And it's showing how they're really, really declining overall. People are pretty freaked out right now, and they're not really willing to take much of a risk. Then this is another sentiment indicator. And I'm not really quite sure how to read this whole thing. This is a different kind of methodology than I'm used to. But right now, it's that we're looking more negative. When this line is coming down, that's negative. When it's going up, that's positive. Well, we were more neutral, but we switched back over to a little red position as of late on this chart. And that kind of lines up with what we're seeing as well. This just shows the Fed funds rate and the Treasury yield, where interest rates are going up as the Fed raises interest rates. It kind of makes sense. They're going up in one part by the Fed, they're going to go up in the other parts of the bonds interest rates as well. But this chart's now already a few days old. So looking at Tuesday's session, one positive thing we could take out is that, yeah, growth was down, but it was down less than value. But then in the mid caps, growth was down more, but in the small caps, it was down a little bit less. So in some areas, growth actually outperformed slightly. The VIX is still going up because of the down day, but we're not seeing a real spike up. We're not seeing that critical mass or that freak out situation that you would want to see at market bottoms. This might suggest that we still have more room to fall. On the other hand, you could take this more positive, saying, well, the people aren't really fearful right now. They are fearful, but not extreme fearful. So maybe the market will hold up a little bit better. And then here's the VIX of the VIX, which has really been treading sideways overall. The Ulcer Index turned back up a little bit more coming off of the moving average. This is another fear gauge, and it's starting to go back up as prices decline. The Mass Index, we're just watching this right now to see if it will generate a signal. We're waiting to see if it's going to go above this blue line. So we're just waiting for that. We're down 19.98%. We're right on the threshold of that 20% decline. If you go back to the all-time high set in January, equity put call ratio, after coming down in Monday session, spiked up a little bit, but is not necessarily extreme on the 1-day chart, and it's still declining on the 5-day chart. Here are the support and resistance levels for Wednesday's session. And here's the daily chart. Now, this is somewhat encouraging, where we came down to this support level, S1, and then we were able to bounce up off of that. So that's one positive sign. So far, some of these levels continue to hold, even though we've lost other levels. We lost this trend line. We're below the moving averages, but the fact that we're still above S1 is positive right now. And here are the pivot points that are good for the entire month of September. And here's really the only Fibonacci chart I have today, is that we're still holding up right above this 38.25 to 38.29 area. We're at 38.55 right now. So these are two different fib levels right on top of each other. So this could be providing pretty significant support. And it's also having a tendency to line up with what we're seeing with the S levels on our daily chart. Not exactly, but they're kind of close to each other. And here's the weekly chart, also holding up above support for the time being. If we break below that, that could turn things a lot more negative. Then we have the 200-week moving average. That's long term. That's still below where we're at right now. The sectors were all negative, with real estate and materials leading the way lower, followed by discretionary. The one that did the least bad is staples, and tech actually wasn't down all that much. Energy fell slightly. And here's our technical analysis score, showing that energy and utilities are still showing really pretty positive technical analysis charts right now, with communication still around that 6.5 area. So this just shows how the energy has held up since the all-time high, followed by utilities, with all of the other sectors being negative. Since then, we still have the S&P in the middle, down just under 20%, with the NASDAQ and NASDAQ 100 showing the most weakness. If we ever do get to the point where we turn around and start to go back up, it'll be the NASDAQ and NASDAQ 100 that typically will lead us higher from here. That's not happening right now. Now they're leading us lower. We had all negative alerts where we had the NASDAQ below 11.5, 11.4. The euro, it actually dropped under 100 when compared to the dollar. The Dow dropped below 31,000. A lot of different sectors are seeing BPI crosses either below 70. That's producing an overbought condition. When they drop below 20, that's a bearish, almost extreme negative condition. And then oil is dropping below 85. So you could actually take that as positive for gas prices. And we still have the mid caps doing the best, even though they're not doing all that great. They come in with the high score of 56, followed by the Dow, which actually improved a little bit at 54. In third place is the S&P. It was up 0.7 according to this score at 45.2. And small caps actually improved a little bit, but they're still at 37.5. And the Qs are in last place, even though they did advance slightly, up 3.7, according to how these scooter reports are scored. All right, let's go back and look intraday. You can see going back to Friday, where we had the gap lower, and then we saw a stronger finish. Monday, gap lower, stronger finish. Tuesday, gap lower, and then ultimately a stronger finish. Now, we didn't go positive, but that's kind of the pattern that we're seeing right now. And this would suggest during these pockets of strength that could be the smart money coming in and buying. Looking at our trend, the ADX is at 20.20. It's right on top of the moving average. We default to negative because the red line, even though it's declining, is on top. And our Arun tends to show more of a negative reading, and we're starting to get even more extreme with this. This could be positive, potentially. Looking at breadth, saw a pretty significant down day based on price and some more weakness based on volume. The advanced decline ratio is under 0 and declining. New highs, new lows. See how we're seeing an expansion of new lows? So that's rolling over our 5 period as well as our 10 period measurements. But this is still kind of positive. The accumulation distribution continues to go a little bit higher. Short-term charts, we might have overdone it in Tuesday's session with the advanced decline ratio. We got a pretty extreme negative reading. We're still below the anchored moving average here, and that would be positive if we could get back above that. Well, we're below that. Currently, the Stochk RSI starting to get extreme negative. Williams percent R, extreme negative. The force index continues to decline. Swinland trading oscillator is declining based on price and volume. McClellan oscillator, not extreme yet, but is declining. Our 20, 50, and 200 period moving averages are also showing weakness, with the 20 shorter term starting to get extreme. We see more of a decline. The 50 could drop down below this line as well, which is more of extreme negative. Stochastic, short term, extreme negative. Intermediate term, trying to turn up, but still extreme negative. Long term, still going lower and also extreme negative. So you can see why I come to the conclusion that we're becoming oversold. A lot of our charts are telling us that right now, but we could still go further. This is also showing continued weakness with the 19-day exponential moving average of the advanced decline line. It's dropping down and could potentially generate a new signal, both based on price and volume. Sean trend meter continues to decline. PMO also declining. The PMOs that are rising is down to extreme negative, as are the buy signals, and we're declining with those above 0. This is another positive thing. See how the Chaikin oscillator continues to advance. It's picking up that we're closing more to the highs. It really liked what it saw in Monday's session. Maybe not as much in Tuesday's session, but it likes this that it's seeing here. And the Chaikin money flow is also showing some improvement. We're seeing a drop off in volume. And our vortex, even though the red line is declining and the green line is going up, they have not crossed yet. So that is negative. Summation index based on price and volume. We were starting to get a little bit of hope here with the volume. Now that's turning back down now. So that's negative and not necessarily extreme. We still have this slope hanging in here. It's rolling over, but it's still positive. But all of our other oscillators continue to be negative. The BPI continues to drop. Ease of movement still showing some improvement. Even though we're below zero, it's gone up the last couple of sessions. The ultimate oscillator is declining, as in the money flow index turned down slightly. The CCI 14 extreme negative, as is the CCI 20, but they do have more room to fall on both charts. This is the negative divergence. See how the Dow has gone up and coming back down, and we have not hit a new low here. Well, we're breaking through that low with the transports. And the utilities have been holding up a lot better. They're not anywhere near setting the low that was hit earlier. So this is showing us a negative divergence right now. The TTM squeeze, this still blissfully just kind of goes higher. As long as these red bars are shaded, it's picking up positive things from that. But it's going against all logic that we're seeing here. Balance of power also showing a little bit of improvement. We did generate a sell signal now with the composite index, where the first sell signal was when it dropped below the green line. The second one now confirms that when it dropped below the red line. Heikin Ashi continues to be negative. The Kegi is negative and turned red. Renko has a solid red box. That's negative. 3-line break, also negative. Nothing new on the point and figure chart, but could turn decidedly negative if we break below these zeros that could be acting as support. The Elder Impulse switched back to negative for the S&P 500 and the SPY. The dots are on top, so the SAR continues to be negative. We're still in deep purple land with the Go-NoGo system. We're declining with our 50, 150, and 200-day moving average, and starting to get a little bit extreme with this 50-period moving average study as well. Special K continues to decline. We have gone back to negative with the diamonds. And here's the Dow, also a little bit encouraging. We came down to this S1 level. Even though we fell below that, we were able to cross back above it and close above S1. And the Qs are still neutral. They also were able to hold support above S1 on their chart. The Vixen's not really spiking up. It's going up slightly, but not all that much, which could suggest that there's more room to the downside. NASDAQ also held this support level and was able to close above that. The mid caps also held support. So there is still some kind of positive things here. The Wilshire also came back above S1 and closed above that as well. The dollar was unchanged, but is still in a strong uptrend. The dollar against the S&P 500, they're having a tendency to go in opposite directions. Gold was down over 0.5% and is just continuing to struggle, as is silver. After it shot up, it's been coming down ever since then. Oil declined to 83.94. The correlation between the S&P and oil, pretty much neutral, but having a slight tendency to go in the same direction. Bonds just continue to show weakness based on price, and we're still going past the low that was set during the COVID lows. And as these prices go down, interest rates just continue to climb. Stocks and bonds are having a fairly strong tendency to go in the same direction, whether it's up or down. Our yield curves, nothing's really changed here. The 10 to the 5 is negative. The 10 to the 2 is negative. The 30 to the 5 year is negative. We're still watching the 10 to the 3 month, which never has gone inverted. And then the tech sector to the 10-year also having a tendency to go in opposite directions. Interest rates really can affect technology stocks. And a lot of the time, they have a tendency to move in opposite directions as interest rates continue to go up overall. Our scenarios, this is just an update. Our cockpit curve has given us a signal suggesting that something big could happen, but we don't know if that's going to be up or down at this point. We're seeing continued weakness with the stocks above their 200-day simple moving averages, as well as weakness with the 50 and the S&P, mid caps and small caps. The 10-day average of the high minus the lows continue to show weakness. And when we look at a broad picture of the highs and lows over a 5-period moving average, this is continuing to be negative and not giving us an extreme reading. Currently, the equity put call ratio is continuing to go up here, but it's not putting in a new spike. Currently, small caps, they closed right just a teeny bit below S1. So we could still say that support is holding for the small caps. They're actually outperforming the S&P over the last few days, but they're still have quite a ways to go to turn up. We're not getting any help from this chart right now. The S&P to the 10-year also going in the opposite direction. And our sector rotation, the Qs are still negative. The discretionary, which has been holding up, it declined slightly. We saw a little bit of an improvement with growth over value with the large caps. And we're seeing still negative pretty much across the board with our other measurements that we use. And the S&P to the 2-year yield, also a pretty strong inverse relationship. And so we just continue to set a new spike. And this is the spike I talked about earlier. We want this to top out somewhere. And when it starts to go down, that often gives support to the S&P. The ratio from the S&P to the utilities, it continues to show that the S&P is going down. For things to turn more positive, we want this to start going back up. Staples were down over 0.5%. And so even though this spiked up a little bit because they were down 0.5%, but the S&P was down over 1%. So this is still coming back up, but we're still quite a bit of ways away from this spike in the ratio. So our outlook, the technicals, they're negative, and the improvements that we're seeing are fading. There's still a few that we can pick out here or there, but the market is really indecisive right now as far as committing one way or the other. We do have the weekly MBA mortgage applications index coming out, existing home sales, some more real estate information, and then the FOMC. They'll make their announcement at 2 p.m. Eastern, and then the press conference will start at 2:30 p.m. Eastern time. The whole list of geopolitical events, there's some more rumblings going on with the whole Russia-Ukraine situation that could come to the forefront. But at least for right now, barring something else happening, inflation, interest rates, and the Fed, those are the real fixation points. So our scenarios, we have to go with the down scenario. Some of the positive things that we're seeing, the improvements, they're fading away. There's still some other positive things that we can look at that support has been holding. But do you really want to take a big position ahead of the Fed announcement? We can't go with the up scenario right now because things are decidedly negative currently. We can't really go with the sideways now because the ADX has gone back above 20 on the S&P 500 and it is negative. So we kind of have to go to the default of things are negative. Now, anything can happen, and there's the initial reaction, and sometimes I bring up a 1-minute chart the day, like in tomorrow's video. If we see real gyration going on after the Fed makes their announcement, there'll be the initial reaction, and then there'll be the reaction that happens during the Fed press conference that Chair Powell gives. And we don't know. Sometimes they go in opposite directions. The initial reaction is one way, and then when he's talking, the market reacts a different way. So it's just a roll of the dice with that. So our conclusion, we're pretty much back to a negative stance overall until we get some clarity on the situation. So thank you. Have a wonderful Wednesday. happy Fed watching. I'll be watching things. We'll try to reevaluate things and then go from there and see where the markets may lead us in the near future.